Welcome to Safe Option Strategies presentation of adjusting calendar spreads. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All right, so if you're going in order on all of the classes, then you previously listened to the calendar spread class, and in that class, you would have heard me say how calendar spreads are one of my favorites, and it has a lot to do with how easy they are to adjust. So the focus of this class is simply that. It's going to be adjusting calendar trades. A quick review of the calendar spread. It's a debit spread, meaning there's money out overall on the trade. We're going to use all calls or we're going to use all puts. We're not going to mix and match there. It takes advantage of a stagnant to a slightly bullish trend or slightly bearish trend. The important thing to know about a calendar spread is they're not ideally set up for fast, strong movements like a bull call spread or a bear put spread, but they are a more flexible trade. They are easier to adjust if and when the time comes that we need to adjust the trade. So that is the appeal of the calendar spread. If the expected move is bullish, we're going to use all calls. If the expected move is bearish, we use all puts. Because most of the time, not always, but most of the time, stagnant trends have a little bit of a bearish or a little bit of a bullish slant to them. We buy to open the trade, meaning we sell to close the trade. We place our long option at the money or close to the money, typically 45 to 90 days out. And if you remember from the previous class, we even spoke specifically about 90 days or farther out is more often going to be the case when we set up a calendar spread. It can be our primary or money-making option, but it can also be the option that just sort of stabilizes the trade while the short option makes us money. The short option nearer term is placed at, above, or below the current stock price and is the secondary or hedging option most of the time. However, it can be the money-making option if the time decay and the value of the option disappears quickly and a lot of the value is maintained in our long option. Our cost basis is the debit of the long option minus the credit we take in on the short option. That is also our maximum risk. And we spent a little bit of time talking about how there's maximum risk. Obviously, if the stock is moving in the wrong direction, there's risk in the sense that both options could lose their value, and that would cause the trade to lose money. There could be risk involved in too big a move up or too big a move down if our short option quickly trended in the money, and if we don't have a bigger difference between our strike prices than the amount of money we paid to be in the trade. I'm not going to spend a lot of time going over that again because that was covered in the previous class. Good target return is 20 to 30%, and we like to be in these trades less than 6 weeks, but it's not uncommon in a calendar spread that we're in the trade just a little bit longer than that. Sometimes it's worth being in the trade longer for the flexibility that comes with that ease of adjustment. So let's get into the adjustment. We've got to talk about two things when it comes to calendar spreads. We've got to talk about how do we adjust for the wrong direction, but also how do we adjust when the stock moves in the direction we would like it to move in, but it goes too quickly in that direction. And both adjustments have to be covered. So we open the trade. Let's use a put calendar. In fact, this is a bear put calendar. And let's just another quick review from the previous class. If our short option is at a lower strike price than our long option, whether it is a put spread or a call spread, we're going to use the term bear. So this would be a bear put calendar. We're using puts, so obviously we use the term put. It's calendar because we're in different expiration days, and we're going to use the term bear, and that gives a complete description of the trade we're in, a bear put calendar. So we set up a bear put calendar, and what would our expectation be for direction on this? If we thought the stock were just going to move perfectly flat, there'd probably be an advantage to doing a put calendar where the strike prices were the same. If we're in a bear put calendar, probably we have an expectation that there is a slight bearish movement. Maybe not a strong bearish movement, but we're expecting that there is going to be a slight bearish movement in a somewhat stagnant trend. Okay, if the stock moves the other direction in a put calendar of any kind, regular put calendar, bear put calendar, if the stock starts to move bullish, we roll our short option and we roll it to follow the direction of the stock. If the stock is moving up, we roll it up. If the stock is moving up a little bit faster, maybe we roll it up and out so that we can get a little more credit. Okay, neither one is wrong, and a lot of it will just depend on how good a credit you can get. If you can get a good credit just rolling it up, just roll it up. Quick thing to note right here, and in the previous time that we did this class live, I probably didn't mention this. One thing to note, never roll out in time. Whether you're going to roll it up, whether you roll it straight up, whether you roll it up and you roll it out, whether you roll it up and roll it out a long ways, never roll it farther out in time than you have to get a reasonable credit. I'll talk in a minute about what a reasonable credit is. To get a reasonable credit, never roll it out farther in time than you have to. The less distance you roll in time, the nearer term you remain with this short option, the more flexibility you have if things then reverse and are going the other direction. You take away some of that flexibility the closer you get in time to the expiration of your short option and your long option. So bear that in mind. Oh, and I did actually put that in. Roll to the shortest expiration, the nearest term. What I mean by the shortest expiration, the nearest term expiration we can, while still taking in more credit on the new short option than what we spent to close the old short option. What is the #1 rule of rolling short options? Always try to get as much or more credit on the new short option as what you are paying to close the old short option. Now, one other thing is, as these short options expire, we can continue to roll them, or as they get close to expiration or they expire, respectively, we can either continue to roll them, or upon expiration, we could add a new short option. So let's say we've got a trend that's looking like this. And I left an old stock chart in here. Don't be. I've got a new stock chart later in the program, so you'll know this isn't a really old recording. You'll know it. You know it's impossible for it to be a really old recording. But this gave me. I left this stock chart in because it's just such a good illustration. We have a trend like this, slightly bearish. Okay, we have no idea that any of this is going to take place right here. We get an indication through technical indicators. This may be when we set up the trade right here. We've got all the indicators pointing down, and the trajectory is kind of a slow downward movement, and we decide to set up a put calendar spread. We get a reversal, and the stock begins to move up. We've got to rely pretty heavily on technical indicators. We've got to rely pretty heavily on levels of resistance. We may not have made an adjustment to this trade. Well, chances are we would have made the adjustment on this big, huge gap up right here, even though there was a little profit taking and continued move up. But when we make the determination, we're going to rely on our technical indicators. We're going to rely on the news that might be driving the direction change. We're going to rely on levels of resistance. We're going to make the best educated guess we can that we're moving into a different trend. And once we've made that determination that we're moving into a different trend, we roll the short put, and we roll it in a way that follows the trajectory that the stock is on. Whether it expires or whether we roll it again just depends on the trajectory that that stock continues to move on. If we're far enough out in time on this long option, we may have a lot of weekly and a lot of monthly options that we can roll to, and we never want to go farther out in time than we have to. I could almost end the class right there and say, when you're adjusting a calendar spread, follow the direction of the stock with your short option. Just roll your short options the way the stock is moving. Just like that. Okay, if we got into a call calendar, or some type of call spread, and the stock reverses, or the stock, okay, let me back up. In this case, maybe we're adjusting a little bit as the stock is moving up, and that's okay. We want it to move up, but then we get the reversal, we roll out, and eventually we roll down. Okay, the key to remember here, the thing I want you to remember is, when you're adjusting a calendar spread, it really does not have to be any more difficult than following the stock with the short option. Let the short option be the chaser. Let it chase after the stock. Try as best you can to keep it out of the money. Okay, that's kind of key. Try to keep it out of the money. And apply the rule of always trying to get as much or more credit on the new short option as what you're spending to close the old short option. Okay, here's a more current chart, so you know we're not showing you a real old class. If we're really long term, we have a lot of flexibility with how we move and roll those short calls. The farther term we are to start with that long call. Now, do we go to the most extreme leap option for our long call to begin with? Probably not. I'm usually not going to be less than 90 days out in expiration on my long call, but I'm usually not going to be much more than maybe 180 days out in expiration on my long call. And a question came in, wouldn't we have used a put calendar on this particular trade? If we had gotten in back here somewhere, if timing-wise we had entered the trade back here and gone to one of our longer-term long calls, we may have got the initial direction movement that we wanted, and then when it reversed, we would still just follow the stock with those short options. Now, one of the most critical things with calendar spreads, as it is with every spread trade and with every adjustment we make, is keeping track of our cost basis and really keeping accurate track of the money in, money out. In a calendar spread, more so than any other trade we do, there is a good chance that one of our options expire and we're still in the trade, and then adding a new option rather than just rolling the option. And because there is a strong possibility of that being the case, it becomes even more crucial that we keep track of that cost basis very accurately. We always have to be thinking money in, money out. Imagine this scenario. Okay, we'll do this on Caterpillar. We buy to open at January. Question came in, do you ever roll the long leg? I'm not going to say never. I want to be careful and not say never, because as soon as you start talking in absolutes, then something happens and you're like, oh, well, I guess here's a new situation. I think it would be an incredibly rare situation where you would ever roll your long option. Perhaps you've been in the trade, you've manipulated and moved and adjusted short options on a number of occasions, and you get to a point where you say, okay, I could still be profitable in this trade if I just extend this long position out one more time, take on a little bit more debit, but the potential credit I can get from a few more short options would make it well worth it. There could be, I could see a scenario or imagine a scenario where you might do that. I think it would be a very rare situation, but it could happen. Okay, so we buy to open a January 90 strike call for a 375 debit. And as part of our calendar, we sell to open the November 90 strike call for a 180 credit. It is so important that you keep track of money in, money out. Okay, this is the net debit to start the trade, but make sure you keep track of your money out and your money in as it comes to adjusting this trade. So the stock reverses and goes a little bit bearish on it. We're expecting a flat trend to maybe ever so slightly bullish, because we decided to use a call calendar instead of any type of a put calendar. So the stock reverses and goes bearish. We roll our November short call out 1 week from the November monthly. If this just says November, it's always the monthly. We roll it out to the November week 4, and we roll it down 2 strike prices to the 88 strike price, and it looks like this. We buy to close. Remember, we originally sold our 90 strike price option for $1.80 credit. Now we're going to buy to close for 81 cents. This is money out. It was money in to open this leg. It is now money out to close this leg. 81 cents money out. Okay, we sell to open this one. We just said we're going to roll it. What I'm doing right here is showing you, this is all done in one transaction, but this is what the roll of the trade is. This is what the roll consists of. Buying to close the existing short, selling to open the new. So we buy to close for 81 cents, we sell to open for 172. So from this cost basis right here that we started out with, we're going to add 81 cents and subtract $1.72. Now, do we very often do it that way? That's kind of the long math, but I illustrate it this way to help you make sense of it. What is our number one goal when we roll a short option? Get as much or more credit on the new short option as what you're spending to close the old short option. A lot of people think they've got to get more than what you originally took in. A lot of people look at what they originally took in and say, I've got to get more than what I originally took in, and that's hard to do. It's hard to find the option and the strike price and the expiration that will do that for you. We're just trying to get more than what we spend right here to close that leg of the trade. And then the net result is a new cost basis of $1.04. We took 195, we added 81 cents to it, we subtracted 172, and 99.99% of the time before we ever did this, we'd look at the 172 minus 81, and what we would actually do is say, this roll is going to lower our cost basis by 91 cents. 172 minus 81 is 91 cents. And we look at this and say, we're going to lower our cost basis by 91 cents, and that brings us to that $1.04. This is the roll of the option right here. These two parts, the money out, the money back in. We now have a cost basis of $1.04 per share. Where do we go from there? Calendar spreads, when they have to be adjusted, oftentimes involve more than one adjustment. So now we're in same trade. It's now been adjusted to a bear call calendar, and it now has a cost basis of $1.04. Our stock levels out. We allow the 88 strike price, the 88 strike short call to expire worthless. Now this is crucial, and this should say November week 4 because we actually rolled it to our November week 4. This is critical. It is so easy for people at this point in time. Remember how much we took in for this short call? The net that we took in was 91 cents. That was the net because we bought to close the other one, we sold to open this one. When this expires worthless, so many people want to subtract that again from their cost basis. And that's not the way it works. We have already accounted for this in adjusting our cost basis to $1.04. So now, when we get the next weekly option at the same strike price, because remember, we're adjusting again because the stock is leveled out, we still have $1.04, and I'm guessing that at this point in time, our long call has lost a lot of its value. There's probably not much value left in that long call. So now we've got $1.04 left. We take in another 65 cents. There's nothing that we're buying to close, so we just get to subtract that 64 cents from our cost basis. We now have a trade, still a bear call calendar, because our long calls are still at a 90 strike, and our short calls are still at an 88 strike. They're just pushed out a week farther. But we've lowered our cost basis now to 39 cents a share. Got to keep track of the money in, money out. Now, at this point in time, there's one of a couple things we could do for purposes of closing this trade. Our new cost basis is 39 cents a share. Once we could close the whole trade, both open legs, for 39 cents per share or more, we have our break even or profit. To break even or profit, we're operating off of our adjusted cost basis. This is how much money we still have at risk at this point in time. So if we could buy to close this option, sell to close that 90 strike, and the combination of the two would give us money in. Remember, this 39 cents still represents money out. This still represents money out. So if we can get money in that totals 39 cents or more, we've broken even. If we want to go back to our original cost basis, what was our original cost basis? $1.95, right? $1.95 was our original cost basis. If we want to go back to our original cost basis and we want to say, you know what, when we got into this trade, we wanted to gain 20%. That was our goal. We wanted this to be a 20% return on our investment. 195 times 20% is 39 cents. I think maybe 25. Let's redo this. 195. Okay, we targeted 25%. I have to say the right percentage here if I want this number down here to work out. All right, let me clear everything off my screen, make this more legible for you. All right, we originally got into the trade for $1.95, and our target return was 25%. That's the ROI we wanted to get on our trade, return on investment. 25% of 195 is 49 cents. If we still wanted to get out and consider it a 25% return on our investment, even though this is all we need to get a break even, this is what we need added to this to still hit our original target profit. So if we could buy to close the entire trade at 88 cents per share, we could still get out with our target profit. Now, how would that happen? Probably when the December week 1 option expires, and because we took in this credit, our cost basis is only 39 cents. If that 90 strike long call that is still out there in time, it's lost a lot of its value, but if it's worth 88 cents or more, we could now close it because it's a long option. Anything we close it for is money in. Is this making sense? Are you understanding how this works? If we want to make a profit, anything above this 39 cents, once we've adjusted to it, is a profit. But calculate your profit on what you originally got into the trade for. The adjusted cost basis is to help you know where can you get out of the trade and not lose money. That's what the adjusted cost basis is for. That's why you're keeping a close eye on that. If you want to calculate profit, calculate the profit off of the original investment you made. Make sense? Okay. This isn't a very long class because adjusting calendar spreads is a fairly easy thing to do. When a calendar spread moves in the wrong direction, we can roll our short option to follow the direction of the stock movement. We can short additional options, calls or puts, depending on what our long option is, at the out-of-the-money strike closest to the price of the stock, and we can repeat this each time they expire worthless. So we can continue to roll the options, or we can let them expire if they're expiring out of the money. And let me add this. If they move in the money, if the short option moves in the money, we're probably going to roll it. If it expires, it better be expiring worthless and not be in the money. As you move your position, keep track of the cost basis. Apply the next short option credit to the adjusted cost basis. And don't double apply a new short option credit. Don't allow yourself to accidentally double count once when you roll an option and again when that same option expires. You don't want to double count it. Set up your new target exit and adjustment strategy, and remember to base your sought-after profit on your original cost basis if you still want, doesn't even have to be the full profit, if you still want profit in the trade. Base that profit. Once you've got that cost basis down to 39 cents a share in the example that we gave, once you've got that cost basis down to 39 cents, you could look at that and say 39 cents times 0.25 is 10 cents. And you could close the trade for 49 cents and you could say, ooh, I got a 25% profit on my trade. That's not accurate. That's not true. You didn't get a 25% profit on your trade. You got a 10 cent per share profit divided by your original 195 investment. You got about a 5% profit. Now, once you've adjusted a trade, if a trade moves against you and you have to adjust it, your number one goal should be to get back to break even. That should be the number one thing you're trying to do. So even a 5% profit at that point in time, I would consider that a major victory. I would say, hey, that's fantastic. I had to adjust a trade because it went against me, and I still got out of it with a 5% gain instead of any kind of a loss. That is wonderful. There's nothing wrong with still targeting your original profit, but make sure you're basing that profit on what your original cost basis was. Folks, I probably should have told you at the beginning of the class, this wasn't a real long class. Adjusting calendar trades, the mechanics of it are simple. Sometimes the timing is a little bit tricky. That's one of the reasons I want people to either attend or watch the recording of as many of the live classes as they possibly can, so that they can see this in more practical, everyday application. But the concept of rolling and adjusting calendars, simple. Thanks, everyone. Have a great day. Bye-bye.